Let's get to our market recap. I want to start with a poll. I was going to say, I remember seeing something about growth indexes. It was in our poll. We asked you, which of these four baskets do you think performs the best through year-end 2020? And I sort of gave you the four main sort of style boxes: smaller, large cap, and growth versus value. Over half of you answered large cap growth. Second was small cap growth. Third was large cap value. Fourth was small cap value. What's interesting about that is a number of things. The large cap growth rate getting killed, especially today, right? These big growthy FANG names are the ones that are dropping pretty heavily today. Everything's down. Don't get me wrong. It's been a tough week all around, but that large cap growth rate is really what we've talked about getting us here. And all of a sudden it's starting to suffer. There have been days when the small cap value out of the 9, Morningstar style boxes, the small cap value ETF has been the best of the 9. So it's interesting to see that happen. So, 3/4 of you are saying the growth trade is alive and well. Let's stick with that. I wanted to mention that because my conversation with Dana Lyons from the Lions Share Report yesterday, he brought a chart of mid-cap growth and small-cap growth and talked about how there was that, basically, if you look at the peak in 2018 and line that up with where we've pulled back to, it's actually a very, almost a similar level. So just as S&P 3200 might be a key level, he was seeing that as a good inflection point as well. So for those of you that are thinking small cap growth, you might want to look at the video. My conversation with Dana Lyons yesterday might help you feel good about that approach. Our market recap is as such: the S&P down to 3270. That was a lot of that, rally came in the last 30 minutes. Before then, we were really at the lows of the day, so saved a little bit of ground, but overall, finishing net negative for sure. NASDAQ 100, the NASDAQ composite down significantly, with the NASDAQ 100 down 2.6%. And obviously a lot of big names in there: Apple, Facebook, Twitter, all, coming down pretty strong today. And that's dragging the NASDAQ down with it. The VIX almost to the 40 spot here. Finished around just below 38. Looking at some other asset classes, bonds are actually an interesting one, breaking down through their 200-day moving average. 10-year yields actually breaking above its 200-day moving average for the first time in a long time. The 10-year yield's now at 86 basis points. The dollar really finished flat, but one of the few things sort of positive on the day. Looking at commodities, the other area that was positive were precious metals, natural gas. These were up pretty good. The commodity complex flat, because oil is a pretty big weight, and that was down. But overall, you had gold and silver up. Let's look at a chart of the S&P. We'll look at some of those other asset classes if we can, and then we'll finish things up. So we were very close to sort of closing within that 3,200 to 3,250 range. We traded down into it. That rally going into the close finished up about halfway up today's price bar, but still, lower than yesterday, finishing, at the lower part of the range this week. So we are certainly within the rounding error of the lows from September. And as we've talked about a number of times in recent weeks and really in recent months after this the sell-off, this peak in June became the low in July, that became the low in September. We're right in that area now. So I think the bullish idea here, if you're bulled up, is thinking this is a lot of great charts at a discount, a lot of good companies at a discount. Stocks have pulled back significantly. This means you can get in at a much cheaper fill than you would have gotten a couple weeks ago. We're 300 points lower in the S&P. That's incredibly tempting, especially if you have a long-term appreciation in mind for equities in general. So we're right at that point where if you're bullish, I think we need to find support. We start breaking below 3,200, making a new swing low. That would complete a lower high, a lower low. All of a sudden, this feels a lot less constructive for long-term appreciation, I would argue, because we've now broken support. And I think if we break below 3,200, I wouldn't be surprised if we see a bit of an acceleration in selling. So I think a lot of people are kind of waiting on there, maybe nibbling a little bit now. And as long as that holds, we're going to feel pretty good about getting good charts and good companies at a bargain. We're going to look at a lot of the charts that, if we look at individual stocks, and on Monday we'll get into a lot more of them, obviously. You're going to find a lot of these are long-term uptrends and pulling back to the 50-day, pulling back to key support levels, has not yet broken the September lows. And a lot of these could be setting up as, we maybe look back and see this as the ideal entry point. For me, though, I don't tend to like buying charts that are going down, just like I don't like selling them when they're going up. I'd much rather see some sort of confirmation, see some sort of buying coming in, show that people are willing to pay a little more than they were in recent days to feel that there's enough accumulation to expect further upside. Looking at some other asset classes just very quickly, because a lot of things sort of in flux right now. I mentioned bonds. We'll look at the TLT here. So we highlighted this last week, actually, when the TLT broke down through its 200-day moving average for the first time in over 2 years. And that's pretty telling. That shows you this rotation. And this completes this rotation from, accumulation phase, from bullish phase in bond prices to a sideways choppy environment for much of 2020, especially the second and third quarters. And now this rotation lower. Now we have a clear pattern of lower highs, lower lows. That pattern keeps merging. And now we're below the Fibonacci resistance. We sort of are unable to overtake that. We sort of retested the 200-day from below now and breaking lower. So I think TLT, I could see that heading to 150. That would be my next downside objective. And certainly there's room for it to go a lot weaker than that. You compare that with what we're seeing on 10-year yields. We can look at this. This is the $TNX. That's the CBOE 10-year yield index. We have another one that tracks 10-year yield as well. Here you can see we're back above 86 basis points, which is 0.86% for the 10-year. So now closing above its 200-day now, following through for the first time since, back here on the left side, we're at the end of 2018. I actually drew this on back here where it's kind of coming up. It looks like we were falling off a cliff and certainly accelerated to the downside here. I've always, I've repeated the catchphrase I heard early on: never confuse the bottom of the page with support. And just because things have gone down a lot doesn't mean they can't go down a lot further. That gave me the confidence that we could go a lot further down in yields. Now, all of a sudden, we're breaking higher. We have higher highs, higher lows in yields. And I think there's plenty of upside for 10-year yields, obviously, right? I mean, there's much higher interest rates can go, and the curve can certainly fluctuate and make that possible. But certainly seeing bonds break down as yields are going higher. We mentioned gold a little bit yesterday, so I just want to revisit it very quickly because the gold chart hanging in there and closing above yesterday, but still really in this midpoint. We've had a narrowing of volatility. The overarching pattern seems to be lower lows, but we've sort of come up and hung up a little bit. So I think breaking down through this last support from September, following through with a break below the 61.8% level. I think that's the downside risk at this point to a long idea. As long as we hold that, you can see this turning. We break down through that. I think you really have to brace for further downside on gold prices. And you can see that the RSI bottomed out at this point around 40, which is sort of right at that point. So, the chart of gold is similar to the chart of the S&P, to be honest with you, in that it's at the lower end of a range that's valid. If it were to bottom, this is about when you'd expect it, right? The RSI is at the pullback point, still within a bullish range. The price hasn't broken down yet through its September low, but overall, it certainly feels heavier than lighter when you look at the action and just the fact that these high prices keep getting lower. We're really not making up a ton of ground on the upside, and never broke above this Fibonacci resistance, which was in line with support here. So that certainly seems like an important level around 180. And until we break above that, it's hard for me to think gold is a great upside play. If we break that, though, I think that opens the door to much, to further upside for sure. Very quickly, let's touch on some other themes we can get through just in a couple minutes. Looking at sectors, you can see that energy was the number one out of the 11 sectors, followed by financials and healthcare. On the downside, not surprisingly, you have technology, consumer discretionary, and communication services. So you really have this binary sort of look today with those three sectors really weighing hard on the index. This is that large cap growth trade we talked about. And again, this could be a capitulation of sorts as things, a puking out to the lows where you want to accumulate. Again, there's an idea for that, and I get it. And for me, that's fine as long. This is a time when I would think stops are a really good idea, because I think there's the potential at the very least a non-zero probability that we go materially lower. So watching for those sorts of moves and key breakdowns would be important. Let's finish off looking at the Mindful Investor live chart list. I want to hit on some of the other asset classes this time. Well, let's get to the rest of the list, as many as we can get through. So number one, the S&P market trend, certainly rotating lower, and now we've locked in a sell signal from the medium term time frame. That's the first time it's been negative since back here in early May. It turned positive after the April lows, or after the March low, accelerating higher. The last sell signal we got was here in February, and this isn't to indicate or suggest that we have a repeat of what we saw here, but it does tell you the trend is aiming more negative than positive. And again, for me, that is one data point among many. That's something I would look at along a lot of other data points, but important to know that that sell signal was triggered today. Short term also negative. That's just below the 5-week exponential moving average. That's sort of my holding pattern, or my placeholder for a short term read. The daily chart's really the main way I would look at the short term, which we'll get to in a moment. And then the long term still very positive, which is absolutely right. We're not far enough off of the all-time highs to think anything differently. We've talked about the daily chart, and again, 3,200, we're right in that range. I think we're in that rounding era where we could find support. It is fascinating to me. It's just poetic that we're hitting this area right leading up to the elections. We've got one trading day on Monday, and then we have election day when we start to see results. And obviously, we won't hear any definite results until after the close of trading, but certainly top of everyone's mind. So I wouldn't be surprised if we sort of chop around here to see what sort of events happen next week. And I think it's going to be very telling stretch there. In terms of breadth, it concerns me back here in early October when the breakouts in S&P large cap and mid cap breadth were not confirmed by the New York Stock Exchange, and the small cap breadth. Now the price has reacted the way I would expect, given the lack of breadth confirmation. Now all four of these, I'll color code these back to orange this weekend when I go through the charts. I see them all as neutral now. I think you'd have to break down through these swing lows from late September to confirm a downtrend, just like the S&P would need to break 3,200. We need to break those for me to turn more bearish in terms of thinking about downside potential from here. At this point, I feel like it's relatively limited, just given the range that we've been in. We are seeing a bit of an increase in new lows, but not enough. I mean, it's not a ton, and certainly not the number of new lows that we had back here in February. That's absolutely right. Leading into the February high, you can see how we had a lot more new lows, especially in the New York Stock Exchange. We at least had a non-zero number there to pay attention to. We haven't had that yet. Again, the acceleration really didn't happen until we came off, and here we were coming off of all-time highs. This is a little different because we've been chopping around for a little bit. I wouldn't be surprised if the S&P breaks below 3,200. You see these red bars start to increase pretty quickly, because you'll see a lot of stocks coming off and starting to test those. But the problem is we're so far away from our 52-week low for a lot of names. That's going to be we'd have to go down a lot to get to that level. So I don't think the indicator is going to have its same impact that it might have back then. This is an important chart, and Walter Deemer kindly tweeted out earlier my take on this. And if at least half of the S&P 500 remain above their 200-day moving average, I'm going to feel okay about the overall market condition in terms of breadth support for an uptrend. If we break below 50%, that is certainly way more characteristic of bear phases than bull phases, and I will start to get a lot. You'll hear my voice get a little more negative than it has been. We talked about sentiment yesterday, so I don't want to kill it too much. I think we did. If not, it's interesting to note 35.3% respondents bullish and the exact same number bearish. It's the first time it's been exactly flat between the two in a long time. It really drives home the indecision that I think we're seeing on there. Final thing, I would just say, listen, there are pockets of groups that are doing well. The relative strength of semiconductors comes to mind as something that's still holding up very well. If you look at the individual names right now, there are stocks breaking out to new highs. There are stocks, many breaking to new swing lows. I think this is more than ever a really good time to scan, especially on a day like today and a week like this. Look for stocks that were able to improve in their scooter rankings. Look for stocks that are able to make new 13-week highs. That's the list I would be focusing on if you're looking for new equity ideas.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.